Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets in Minds, the show where we break down big macro themes into simplified trade ideas. Markets have once again become concerned about the possibility of rising inflation in the USA and the effect that this could have on interest rates and corporate earnings. The thinking being that in order to stop the economy from overheating, the Federal Reserve will be forced to raise interest rates quicker than it would otherwise like to have done, and that rising interest rates and rising prices will bite into corporate earnings and share prices. The equity markets had another wobble with the release of April's inflation data, which showed that the annual rate of inflation in the U.S. was up 4.2%, up substantially from a print of 2.6% seen in March and well above Wall Street forecasts for 3.6%. There were substantial price rises in gasoline, fuel oil, and used cars and trucks, which are very much in demand as the economy begins to reopen fully. Shortages in the supply of microchips have limited the availability of new vehicles, which in turn has helped to drive up the values of pre-owned autos and trucks. The closure of the Colonial pipeline that delivers petroleum products to much of the East Coast following a hack has also created temporary shortages and sharp price rises for fuel. These events were not reflected in the April data, of course, but will likely show up in the May inflation report. The Colonial Hack is likely to have been a one-off event that won't be repeated, and the Fed thinks that a sharp rise in prices across the wider economy will also prove to be short-lived and transitory, and is therefore reluctant to move interest rates ahead of schedule. However, the hawks in the market believe that if the Fed fails to act on interest rates before 2022, then it may literally end up being behind the yield curve and have to chase rates higher. This is why we saw the NASDAQ 100 index sell off by minus 2.4% last week, having been down by as much as 3.4% at its lowest point. Technology and growth stocks are seen as being the most vulnerable in an economy that has rising prices and rising borrowing costs. At this stage, it's far from certain that this is what lies in store for America, and a single high point in monthly data is no real guide, particularly in the current climate, which is anything but normal. Strategists at Credit Suisse recently highlighted that 60% of the costs within corporations come in the form of wages, and that figure was even higher for the service sector. So it seems sensible to assume that wage data will tell us if inflation, and by extension the wider economy, is going to run hot throughout the rest of 2021. The Swiss bank pointed out that the real unemployment rate in the U.S., known as U6, is still at 9.2%, far higher than the more broadly publicized U3 unemployment rate, which is running at 6.1%, and still well above levels seen before the pandemic. The bank's thinking is that this additional slack in the labor market will help to keep wage demands under control, particularly when additional unemployment benefits of up to $300 per week are wound down in September. But what if wages and prices continue to rise and the Fed is forced to shift the dial on interest rates this year? Where can investors find stocks that could benefit from those conditions? The answer to that may be value stocks, typically established businesses within what we tend to think of as the old economy. Stocks whose share prices may not fully reflect the true worth of the enterprise and its assets. One way to find value stocks is to screen for shares with a low price-to-book value and undemanding price-earnings multiple. For example, looking for stocks within the S&P 500 index that have a price-to-book ratio of under 2, a current PE of less than 20, and a 12-month forward PE ratio of 15 or under. Using a stock screener, we find 17 stocks that meet these criteria. What's even more interesting is the fact that most of these stocks are financials, the exceptions being Ford and GM. The other 15 stocks are banks and life assurers. These types of financial stocks typically see their earnings grow as interest rates rise, simply because they can earn a bigger margin on the loans and investments they make, and the financial products they sell when interest rates are rising. Of course, we have used a very simplistic screen across a relatively narrower large-cap universe, and there are likely many other candidates out there. But it serves to show just how traders can identify potential opportunities as and when thinking in the market changes. That's all we have time for this week. Please make sure you do your own due diligence before making any investment decisions.